Help break down today's trading action. Julie Hyman and Adam Johnson over at our markets desk. Standing by at the CME Group in Chicago is Jessica Hoverson of MF Global. Jessica, by the way, responsible for statistical and macroeconomic analysis of global markets, also produces daily analysis on interest rates and currency markets, so she's been pretty busy. Also back with us is Mike Darda, the chief market strategist over at MKM Partners. Michael says equities are the most compelling asset class for investors who can handle the volatility. So, Michael, I got to start with you. The most compelling asset. I mean, how can you say that to investors who, since about April 23, have seen their portfolio, if you will, down more than 10% here? I mean, they've just watched their equity portfolios decline.
Well, if they got in on April 23rd and they've been out of the market before that, then shame on them. But if you take a look at valuations, you just use a normalized 5-year average for forward earnings estimates. The S&P 500 after yesterday's close was trading at a multiple just over 12 times, 8%. Earnings yield on the S&P, that's more attractive than corporate bonds, which are at about 6%. Treasuries are at 3.2%. And some of these favored asset classes like gold are actually trading at a very high premium to purchasing power parity, or where they normally are relative to other asset classes. So if you can take the volatility, this is a correction. It's a brutal one. There are some disturbing things taking place in the funding markets. So I don't want to completely write off the risks that are out there. But if you can deal with the volatility, I think we're probably closer to the end of this bout of weakness.
And Michael, that's something, I like to bring up a lot. I mean, we're focusing so much on the European crisis, fiscal crisis, if you will, but just take a look at kind of the books here on the federal government level or the local level. I mean, at some point, that day of reckoning is going to come for both the fiscal, for the federal government and the state governments. It's kind of coming already if you look at something like California.
There's no doubt about that. Our fiscal situation from a structural perspective is certainly problematic, although if you take a look at the action in the U.S. Treasury market, it certainly doesn't look like investors are pricing in a Greek scenario for the U.S. bond market. So I think some of those risks are longer term. I don't disagree that they're not out there, and I'd just like to also point out, I'm not saying, look, this is a 100% guarantee that we're at a low here. Of course markets can go lower, and when you've got pressure on short-term funding markets, that's always a warning sign. So I'm not saying that. I'm saying we're in a correction. I think the bulk of it is behind us. And if you can take the volatility and deal with that equities are probably a more attractive asset class than commodities, than gold, treasuries, even corporate bonds.
And I actually want to talk to Mike Darda about that because, Mike, I know you don't like gold here. And even if your perception is that the bulk of the stock declines are largely behind us, I mean, isn't there still enough concern out there that's going to continue to fuel this bid for gold?
You know what? It's a great question. It very well could. I just don't like gold based on the fundamentals. I mean, this is a very well-told story. Gold is a popular investment vehicle. Obviously, there are good, strong macro tailwinds for gold, or it wouldn't be behaving the way it is. But on a purchasing power parity basis, meaning if the gold price was essentially reflecting the change in prices going back to the beginning of the Federal Reserve System, it would be about $4.50 an ounce. So considering where gold is now, there's already a massive amount of future inflation priced into gold, or end-of-the-world risk priced into gold. On a purchasing power basis, gold's about 3 standard deviations over the mean. So you've got to go, the only time in history it's been more rich on that basis is from 1979 to 1981. So Mike, maybe we revisit those levels, but it's not compelling on a valuation basis.
I mean, Mike, this all sounds very logical and very reasonable, and yet that's not necessarily what's fueling what's going on in the market right now. I mean, when do you think that things might calm down and people might look at the markets, if ever, with a little bit more of a reasonable eye?
Well, I think that, there'll probably be tense nerves for a while. I think this is an aftershock. This is likely not a repeat of 07, 08 for the global economy or the credit markets, but aftershocks can be brutal. They're not going to be as bad as the original crisis. But at the end of the day, you have to take a step back and look at markets with a cool head and ask yourself, what's the most attractive vehicle to be in? I'm just fearing right now the retail investor who bought tech stocks in late 99, early 2000 and got blown out of the water and then bought housing in the middle of '06 and blew up is now buying gold aggressively. You can't go to sleep at night without flipping through the channels and seeing an infomercial pushing gold. So, on that basis, I just give people a bit of a warning.
You this, Michael. Another viewer writes in and asks if you're concerned about a liquidity trap. He says the Fed has been increasing the money supply, but we see little or no economic growth as a result. What do you think about that?
I think that concern gets bigger if we do see a all-out relapse in the credit market. So recently we've seen stresses reemerge in short-term funding markets. That's got to be watched very carefully because sometimes that's where it starts. But as long as that doesn't move into the corporate bond market in a major way, then probably not. I don't buy the liquidity trap idea unless you've got the corporate bond market collapsing. Then you get what looks like a liquidity trap, but in actuality it's a falling velocity of money. Interestingly, we're just starting in the U.S. to see a recovery in the velocity of money. Q1 was the first year-over-year increase in M2 velocity since 2006. So as long as this credit market weakness doesn't get too much more severe, I think the liquidity trap idea, is really in the rearview mirror here.
Hey, Mike, I got to bring you into something that Matt and I are getting some emails from viewers. They watch what you guys say very closely, and they're talking about how you were bullish back in 2007, 2008, and said that we would have been crushed if we listened to what you're saying, that you're always upbeat. I mean, where do you find
That's nonsense. Hold on a second. Let me defend myself. Yes, I turned negative too late. I did miss a few hundred points on the S&P 500, but we can replay the tape. We sent out warning after warning after warning to our clients in the summer of '08 when the S&P was at 1,300 before the collapse, and I was one of the first to get optimistic in late February of 2009, pretty darn close to the lows, and I think we did a good job with the corporate bond market too. So it's not a perfect track record, but I'll put it up against virtually anybody else's.
All right, but fair enough. But I mean, there are a lot of obstacles out there, and there is some concern that the economic recovery, which is so fragile still, Mike, at this point, that's going to come undone. I mean, you've seen what the European crisis has done to the market. We're not over yet. You listen to Jessica. I mean, there could be more rounds of this crisis. I mean, where do you really get your optimism from?
Well, at this point, I think you do have to make a judgment call. Financial conditions are tightening. That should not be ignored entirely. There are risks out there. The stock market is in a correction mode. So you've got to make a decision. Are we going to see a relapse of '07, '08? If that's the case, crawl into the bunker and do not come out. If this is an aftershock and simply a severe correction, then I think it's time to step up to the plate and put a little bit more risk on the table.
This, Mike, we only have 10 seconds really left, but do we have to see a restructuring of Greek debt?
It's a tough one. You know what? They've got time. I think they've got 1 to 2 years. The jury's very, very much out on that score, though.
All right. Hey, Michael Darda, thank you so much for joining us.